Hey guys, welcome back to another video. My name is Josh, and in this video we'll be talking about all things recovery stocks, and I'll also go through 5 different stocks that I think are recovery stocks that are listed on the NZX. So the reason why we're talking about recovery stocks today is because early in the morning we got news that the US pharmaceutical giant Pfizer as well as a German firm BioNTech have announced their experimental vaccine being 90% effective in preventing the Rona. And early in the morning as well, we got news that the New Zealand government has signed a deal with Pfizer and BioNTech to secure 1.5 million doses, enough for 700,000 people in New Zealand to prevent the Rona. And this could be delivered to New Zealand by the first quarter of 2021. And as well as that, we also see that Pfizer has estimated that 50 million doses of its vaccine could be available by the end of 2020 globally, which could cover 25 million people since each person is given 2 doses. So on this news, global markets were up, especially the Dow Jones as well as the S&P 500. In New Zealand, the NZX 50 was up early in the morning around 2.15%, but they slowly lost their gains throughout the day to the time of recording to roughly 0.37% up. So in this video, I crunched the numbers for 5 different stocks that I think are recovery stocks. And what I did was I compared the previous year's earnings to the current market capitalization of the businesses to see what sort of valuation you're currently paying for these beaten down businesses. As well as that, if you're analyzing some of these recovery stocks, what you need to realize is that a lot of these companies have issued additional shares when they needed the money during the Rona situation. And what this does is that it actually dilutes the earnings per share for each individual stockholder. Because for example, if you have more shareholders currently, you are sharing the same pie across more shareholders, meaning that each shareholder gets less earnings per share. So what I did was I removed the impact of share dilution in the case where there was share dilution, by looking at the market capitalization instead of just looking at the share price. So hopefully you find this helpful, and as always, this is not financial advice. I'm not a financial advisor, and none of this is any recommendation to buy, sell, hold any stock. And yeah, full disclaimer down below, but let's get right into stock number 1, and that is Auckland International Airport. So in case you don't know, Auckland Airport is the largest and busiest airport in New Zealand with over 21 million passengers in 2019. So year to date, the company is down 16%, but today the shares have gone up 7.88% as at the time of recording, roughly 3 o'clock. Okay, so this video will probably only come out tonight, but as of recording, it's $7.67. So here we have 2019 numbers for Auckland International Airport's underlying earnings. So this is in millions, so that's 274 million. The market capitalization at the time was $11.9 billion, meaning it had a PE ratio of 43 times. The higher the PE ratio, the more expensive the company is, because what this number means is that you need to invest $43 today to get $1 of earnings back. So the higher the number, the more expensive a stock is. You can recalculate the PE ratio by taking the market capitalization divided by the underlying earnings. And in 2020, numbers based on today, so the underlying earnings is 188 million. But the market capitalization is 11.3 billion, meaning it has a PE ratio of 60 times. So this number is higher than this because currently the earnings have dropped quite significantly. So the PE ratio is much higher. But we can't assume that going forward the company will always earn 188 million because, you know, with the recovery in the economy, with the vaccine coming out, their earnings should recover. So let's assume that they have fully recovered to pre-Rona levels. So we give them an underlying earnings of 274 million. Assuming that you buy today, this is the market capitalization that you're paying for the business. So that's $11.3 billion, which means you have a PE ratio of 41.44 times, which is lower than the 2019 levels of 43 times. And that is a discount of 5% comparing today versus pre-Rona. And here you can see the impact of the share dilution, because if you look at the share price is down 18.3% since pre-Rona levels. However, when I'm calculating the discount, including the share dilution, you're actually only getting a discount of 5%, because remember, you are getting less earnings for what you pay because there are more shares outstanding. So once you take into consideration that there's more shares outstanding, the discount is actually less than what it seems like. So that's why I wanted to do this, to show you guys that when you're looking at recovery stocks, don't just look at the share price, you also have to take into consideration whether the company has issued more shares. So currently, Auckland International Airport doesn't look as cheap as it seems if we're looking just at the share price itself, and as well as valuation wise, a P ratio of 41 times is relatively high compared to the market. You're not getting really a big discount. So looking at this, Auckland International Airport doesn't look like it's a cheap deal at the moment. So moving on to stock number 2, we have Air New Zealand. So Air New Zealand is a company that didn't have its share diluted. Air New Zealand is down 47.54% year to date, but today it is up 6.67% on news of the vaccine. Air New Zealand needs no introduction. It is the flag carrier airline of New Zealand. And looking at the numbers here again, underlying earnings is down from 276 million to a loss of 454 million. So let's assume fully recovered amount is 276 million. Current market cap is 1.8 billion, and that is a drop from 2.976 billion in 2019. Currently, you are paying only $1.8 billion in terms of market capitalization. In 2020, the PE ratio was negative 3.97, but assuming that they're fully recovered, you're paying a 6.53 PE ratio on today's price for a fully recovered underlying earnings of $276 million, which means a discount of 39% compared to its pre-Rona price. Now I have to caution you on this one. Air New Zealand is a very cyclical stock, and the underlying earnings in 2019 was at the height of a boom economy. And now that we're in a recession, and with the whole Rona situation, we don't know when air travel will return to normal. It could be 1 or 2 or 3 or 4 or 5 years, right? So this is assuming that it's recovered to last year's levels. We don't know when that will be, but if it does recover, today's price does seem very reasonable because you're only paying a 6.53 times valuation. Okay, so that's something that you need to decide. I can't decide for you on whether you think that is a reasonable number, but comparatively speaking, a 6.53 P ratio is relatively low to the market. So next stock that we have here on this list is SkyCity. SkyCity is a gaming and entertainment company, owns and operates 5 casino properties in New Zealand and Australia. Year to date, they are down 19.4%, but today they are up 6.67%. So here we have underlying earnings for SkyCity in 2019 of 164 million. 2020 earnings of 66.3 million, so a drop of roughly 100 million in underlying earnings. The market cap last year was 2.5 billion. Today, they are $2.4 billion. So it's not much of a gap what you're paying before and currently, right? P ratio wise, they have a P ratio in 2019 of 15.3 times, but assuming the earnings fully recover, then you are paying a P ratio of 14.87 times, representing a 3% discount today compared to pre-illness levels if the underlying earnings recover to pre-illness level. So this is not a big discount compared to pre-illness level, but then if you're looking at the underlying PE ratio, it's also fairly reasonable at roughly 15 times, okay? But what this tells me is that the market is expecting SkyCity to recover relatively quickly because there isn't much of a discount compared to its pre-illness levels. So from what I can see here is that SkyCity isn't very expensive. They're only trading at a 14.8 0.87 times PE ratio, assuming they fully recover. But what I don't like really is that the discount that is represented is only 3%, which means that the market is forecasting a relatively quick recovery for SkyCity. If recovery is slower than expected, then that might mean a negative impact on the share price. So moving on to stock number 4, here I have Tourism Holdings Limited. And in case you don't know what they do, Tourism Holdings Limited, or THL, is engaged in the manufacture, rental, and sale of motorhomes and other tourism-related activities. Currently, their share price is down 24.93% year to date, but today the share price has increased by 11.16%. Looking at the numbers here, underlying earnings have dropped 7.9 million this year to 20 million. The market capitalization has also decreased by over 100 million from 499 million to 383 million. If we assume a fully recovered THL, that would mean buying in today will give you a P ratio of 13.74 times, which represents a discount versus pre-Rona levels of 23%. Okay, so that is quite a big discount, and this company has also a relatively low valuation multiple. This company might be a good one to look at if you're looking for beaten down, damaged recovery stocks. If I am interested looking at these numbers, then I can go deeper into looking at the business model, looking at their revenue streams, looking at future growth rates to decide whether this company is worth buying or not. But from what I can see here, at least, we can see that Tourism Holdings is relatively cheap compared to the other stocks. The last stock that I have on this list is Vista Group International, and they are a company that provides fully customizable cinema enterprise system to cinema operators. So needless to say, cinemas have had a really tough time with the whole Rona situation, but with the vaccine around, this might start to change. Vista is currently down year to date 47.98%, so that's a huge drop, and currently today they are up 20%. Looking at the numbers here, underlying earnings have took a massive turn from a positive 10.8 million in 2019 to a negative 11.8 million in 2020. Market capitalization wise, this is a relatively small company as well. 621 million in market cap in 2019 and 416 million in 2020. So assuming that they're fully recovered and a market cap of today, you're buying them at a P ratio of 38.53 times, representing a discount pre-illness of 33%. So this is a relatively big discount. Vista does have a relatively high P ratio compared to the market, and that's because the market does expect Vista to have a higher growth rate going into the future. So that makes up my list of the 5 recovery stocks that I've taken a look at on a valuations basis. However, this is not a recommendation to buy any of these cheap stocks, but personally, I think this is a good way to start looking at recovery stocks by taking into account the dilution impact of any capital raising, as well as looking at what the normalized earnings would be once the economy is up and running to pre-Rona levels. The issue with this exercise that I've just done is that it doesn't allude to how long it will take the company to fully recover. So that is up to you to assess whether you think the company will fully recover their earnings to pre-Rona levels. The quicker they can recover, obviously, the better the shares will do. But at the same time, if they don't recover as fast, then you can expect the share price not to do very well going forward. So based on this exercise, we can see that Auckland International Airport doesn't look like there's a big discount to its pre-Rona levels. Same with SkyCity as well, but others like Air New Zealand and THL does look relatively cheap if you compare them to their pre-Rona earnings levels. That is the purpose of this exercise, and as always, this is not financial advice, so let me know down below which stocks that you're betting on for a recovery gain, and I hope you enjoyed this video. Thank you for watching. Until next time, take care.